Hey friends, it's Save My Sense. I am America's leading retirement expert, and today I'm going to tell you about the worst investment that I have ever made. This was back in 2012 when I was 25 years old. Back then, I hadn't had as much of the knowledge that I have today at 39 years old when it comes to saving and investing in retirement in the United States. I was high income. I was making more than $100,000 living in the heart of San Francisco. I was not yet married. I was dating my husband at the time, but we were not yet engaged. And I would say that back then, I also really liked enjoying the life and living the life of what I hope to be the path towards becoming a very wealthy person. Contrary to popular belief, there's actually no nationwide law that requires that financial advisors are fiduciary to you. What does fiduciary mean? It means that a financial advisor is going to do to the best of their abilities to make you the most amount of money possible. There are some exceptions. Most people who are in charge of 401k plans and pension plans do have to be bound to that fiduciary standard. But for most of the rest of us, when we go up to any financial advisor with our IRAs, our cash, our real estate, our taxable brokerages, our stock investments, to the best of my knowledge, most financial advisors are just going to be held up to what's called the suitability standard, which means as long as they make you some money, they're clear. And that is what's so infuriating about the United States financial system, is that there is no adequate consumer protection in place to make sure that we, the ordinary people, would be able to make the most amount of money from our investments at the lowest cost. So understand that this has created an entire industry that is profiting off of the lack of this amount of accountability. And that's what brings me to the industry called the life insurance sales industry. My story was back in 2012, I was making six figures. I also had my own side business. I was a wedding photographer. And at that point, I was already maxing out my 401k. So at that point, I was already contributing more than $20,000 a year to my 401k. And I did meet somebody who told me that I was making too much money to do a Roth IRA. Nowadays, there's a way to work around it, but back then I didn't know about the backdoor Roth IRA. I was working with a tax accountant in Massachusetts to do my taxes because back then my primary residence, my home, actually owned a condo that was still located in Massachusetts. And I asked him, do you have another financial advisor that I can speak to figure out how to optimize my tax situation? And this guy referred me to this financial advisor based out of Massachusetts. All of our discussions were over phone at that time. There was no Zoom, by the way. This is 2012. And I never met these people in person, which I think was probably part of the issue. I noticed that these people were very eager to speak to me, always really excited to get on a phone call with me, always emailing me afterwards, coming up with all of these illustrations and follow-ups. That was red flag number one. Red flag number two was that they constantly harped and hyped me up about the fact that I was a high income earner. You'll often find that these life insurance salespeople like to go after people who are likely to be very high earners and want to think about having a legacy, want to think about building up generational wealth. And then finally, they were not transparent at all about who their company was or who they ultimately worked for. And that's because in the life insurance industry, you have the insurance issuers. These are companies like MetLife, Guardian Life. They are mutual companies that create insurance policies. And then these policies can be packaged and sold through agents. And agents can establish, any agent can establish their own company to do it. And so the financial advisors that I spoke to had their own company that had a very financial advising type of name to it. But I would later find out that they were actually agents for Guardian Life Insurance Company. I had purchased a whole life insurance policy. And let me just explain a little bit about how these policies worked. Whole life, variable universal life, index universal life, all these are financial products that all do some similar thing where one, they do provide life insurance. So if you die, the insurance pays out at its face value. That's one key term to know, face value. And then during your lifetime, you're paying premiums into these policies to basically keep them alive. As your premiums get paid into the policies, the insurance companies will take a part of that premium and set it aside and basically let it invest in the policy. And so it build up either dividends or interest over time inside the policy, and that's known as the cash value of a policy. This is true regardless if you do whole life or index universal life, variable universal life insurance. All these insurance policies are basically going to have some kind of payout rate. Whole life insurance basically means that you're investing in the insurance company and you get a share of their dividends. Variable universal, index universal life insurance policies usually peg the growth of the policy against something like the United States index funds, like the S&P 500, and basically derive, meaning that they kind of match the growth on the market, but not entirely. Usually there's a cap on how much that they will match the growth. The whole life insurance policy I bought was a $550,000 face value, meaning that if I died at any point during the policy, it would pay out $550,000 to my children or my descendants, and that it would be paid up at age 95, meaning that if I made all of the minimum payments on time all the way up to age 95, it would become $550,000 in value. And it had a rider, it had a feature, basically. I hate how fancy these terms are. These terms are so annoying. But I had a rider that meant that if I made above my typical premium payment, which was at that time $5,000 a year, if I made an $8,000 a year premium payment, it would accelerate the growth of my policy, meaning that both the face value, which is how much it pays out to my children, would grow, and also the cash value, the money that's building dividends inside my policy, would also grow faster over time. Since I was young, I figured that I would pay the $8,000 premium, make the policy grow faster, build up more dividends, such that by the time I became a mom and had children, then I was hoping, using my sort of back calculations, that the dividends would have built up enough that it could then cover my premium for a couple of years, because I assumed that during early motherhood, I wouldn't be making that much income. And then I would hope that the policy would grow, and then I would eventually, I wasn't going to die and leave the face value. My original strategy was to actually borrow against the policy, because if you borrow against the policy, then the money comes out tax-free. That was one of the benefits that the financial advisors sold me on. And that was what I bought. Well, I will tell you this. 9 years into the policy, I had made about $80,000 of premium payments into the policy. The face value of the policy grew to about $70,000. The face value went from $550,000 to a little bit over $700,000, but I couldn't borrow against the face value. The only amount that I could borrow against was my cash value. Had I been investing all of my premiums during that time on the stock market, I would have had way more money to show for my effort. And at 9 years in, I was, by that point, a mother. I was like, this is really just not worth it. I had built up a lot of investments on the side into other things. Like I invested in my 401ks, my backdoor Roth IRAs, my taxable brokerage. I had, 7-figure net worth by that point. I was like, this is not worth it. So I cashed out, I surrendered my whole life insurance policy, and I got about $70,000 back, which I then took and invested into a taxable brokerage. There are going to be a lot of red flags and a lot of selling points that these financial advisors are going to use to pressure you into buying such a policy. The first pressure point is that they're going to lean on the nature of the relationship to you. Now, thankfully, I didn't have a personal relationship with this financial advisor of sorts, but many times I've had coaching clients who buy these insurance policies from relatives, family members, friends of friends. This kind of reeks a little bit of MLM, right? A multi-level marketing scheme, and that's exactly what it is. These insurance companies and their agents, they basically create these levels of agents who are pushed to sell as many of these policies as possible because they make a commission on these policies, and then so who better to sell to than family and friends who trust them? And I think I wish at that time that I had already been living in New York City. And I think New York City made me a lot more wiser to the point in that when you live in a big place like New York City, you grow to understand why institutional trust is important, why it's important for people to actually come from a vetted background in finance, that they have studied investments, that they did work for bulge bracket banks. Because I later realized the two people who worked as insurance salespeople had less education in finance than I did. And I was like, why the heck would I associate myself? And I know this is the arrogance in me speaking, but why would I be associating myself with people who knew less about finance and investing than I did? And once I actually became LinkedIn connected to one of these people and I started seeing the stuff that they were sharing, I was like, it's absolute BS. The stuff that they were sharing was terribly written, terribly researched. And that's when I started waking up to the idea that, oh my goodness, I basically bought from salespeople. Next point is a lot of these people target high income people because taxes. Once you make more money, you do start getting more concerned over how much income taxes you pay, whether your estate grows to a large enough point where your children are going to have to pay estate taxes when you die. The thing is though, these financial planners are not going to tell you that there are already very legitimate low-cost ways to lower your tax liability. For example, they're all going to say, many of them are going to say 401ks are a scam. You're still going to be taxed at a very high rate when you retire. What they're talking about is money in the 401k that is characterized as traditional or tax deferred money, meaning you don't pay income taxes right now, you defer it until when you withdraw it in retirement and then you pay taxes on it. But what they will fail to mention is that there's also Roth 401k and the equivalent. In fact, many people today can put away more than $23,000 a year into their 401ks Roth, meaning that you pay all your income tax on it upfront today and it grows tax-free. Same goes for Roth IRA, and then now as a high earner, I can do what's called a backdoor Roth IRA and do the same thing. Furthermore, if you put your money into a taxable brokerage, which is an account that doesn't have any of these tax benefits like the 401ks or the IRAs, you can actually also stay below a certain amount of withdrawals that may avoid capital gains tax. Capital gains tax is what's charged on your sales within the taxable brokerage, and it's charged on the difference between what you bought an investment at and what you sold at. And if you made a profit, then they're going to charge a capital gains tax. And there's both federal, and then depending on which state you live in, there's state. The thing is, if you can be very frugal in retirement, either as a single, filing single or married filing jointly, there are thresholds below which you wouldn't be charged capital gains tax. Now it's $40,000-ish for a single person, $80,000 for a married filing joint. But you know what? That's still a threshold, meaning that not everything that you sell during retirement gets taxed. These financial advisors are not going to talk about that. Another thing they're not going to talk about is estate taxes. At the federal level, right now, as it stands, and I do recognize the laws can change, a single person can basically pass down an estate of up to $10 million without really hitting any estate taxes at the federal level. Now, this does vary by state, but at the federal level, your first $10 million, and if you're married, combine that together, your first $20 million passes to your descendants tax-free. Most people are not going to reach that amount of wealth in their lifetime. But again, your insurance sales agent is not going to say about any of that. All they're going to do is scare you and say you're going to have higher taxes are going to rise, better try to find a tax-free way. And that's why they're going to recommend these life insurance policies, because it is true, if you put in and you buy a life insurance policy, the life insurance benefits get passed on to your children tax-free. But that actually tells me that it only really matters for people who are so high net worth that they are likely to exceed the $10 or $20 million lifetime estate tax exclusion amount at the federal level. And if that's the case, then yeah, super rich people would buy these products, but not as an investment, but mostly as a tax shelter. And again, most of the people watching this video, you're probably not at that point. Investing. As a person who has now invested both in the United States stock markets and also a little bit of real estate for over 20 years, I can tell you what a sound investment should look like and what it isn't. And I will tell you, these life insurance policies are being sold to you like investments, but they do not behave like investments. Here's a couple of things. First off, you should have transparency into pricing for an investment. For a house, you can look on Zillow or Redfin or Realtor.com and see what people think a house is worth. For a stock, you can go on any stock website like Google Finance, Yahoo Finance, and you can get a quote for the stock right there. A life insurance policy, they price it to each individual, and that pricing is not transparent. And there is no database where you can publicly go and look at how life insurance policies have trended and grown over the past. I mean, sometimes the companies will announce what their historical dividends were, but it's all very opaque. And it was nearly impossible for me to get any sense of what these products did historically. I tried, and I saw some tables, but not a lot. And that's because life insurance companies, more or less, are mostly private companies. They have no obligation to make any of their financials public because they're not being traded on the stock market. And that's another point why these are not investments. If you are buying into an investable asset, you should be able to trade it. Stocks are traded on the stock market. Homes can pass hands. Heck, even if you buy a Pokemon card, you can trade it on eBay. You can't trade a life insurance policy. You can't sell your life insurance policy to somebody else. You can only surrender it back to the life insurance company. I don't call that an investment, but you will often be made to believe by many of these agents, even if they don't directly call it an investment, they're going to use a lot of language to frame it like this is supposed to be a wonderful investment. And after having invested for 20 plus years of my life, I can tell you these products do not behave like investments. They're a financial product that you pay for, but it's not an investment. There's this weird term called infinite banking, and it's a term that life insurance agents love to talk about. They're like, oh, the cash value that you have in a insurance policy is something that you can borrow against. And then as your insurance policy grows over time, it will cover the premiums on the cash value so you can borrow it again and again. And they make it sound like it's the best thing since sliced bread. Infinite banking. You become your own bank. You don't need to rely on another bank. I fail to see how this is some innovation. Anything that you own, any asset that you have can be borrowed against. Think about it. If you have a home, you can do what's called a HELOC, home equity line of credit. That's borrowing against your home. If you have a car, you could use it as collateral, and you can create a loan against the car if you really wanted to. Plenty of people bring artwork, and I don't know, some people bring like a deed or something when they go gamble, right? Because you can put down collateral to gamble or borrow against. If you invest and you're more like a day trader or options trader on the stock market, you also know that the existing investments that you have can be used as collateral, can be used as margin when you're trying to borrow for your next trade. All assets in the United States, if you are creative enough, can be borrowed against. Infinite banking is not some fancy, unique thing that only you can do with a life insurance policy. You can bank, you can borrow against any asset that you own. Limited downside. I think this is where a lot of people who hate risk are sold into buying a life insurance policy. Because especially if you have a index universal life insurance policy or a variable universal life insurance policy, they'll say, hey, these policies kind of follow the index of the United States, like the S&P 500, they'll grow, but you don't get any of the downsides. So if the market crashes, your investment in this life insurance still lays kind of flat. There are other things that do that cost a lot less than the premium that you pay to have a life insurance policy. You know what those things are? Treasury bills. You can buy bonds backed by the United States government that also grow over time, that protect you against inflation, that also don't fall in value. And if you move away from United States bonds, there are also other types of bonds that are pretty highly rated that do basically the same thing. Heck, you can park your money in a high yield savings account, make some interest on it, and it's very unlikely that that would fall in value. Just because you fear losing money shouldn't be the main reason why you would buy such a life insurance policy. Now, granted, people do have different risk tolerances, and some people just need more stability in their lives, and that does make sense. Some people have what's called more conservative portfolios, where you're more likely to hold stable assets like cash, bonds, treasury bills of that sort, instead of more risky assets such as stock investments. But even so, a life insurance policy is a very expensive way to have something that's stable. You're paying a lot in fees for something like that. And also over time, many people who are sold these policies should actually be investing more. I often find amongst my coaching clients that they're being pressured into buying these life insurance policies as a way to invest, when they actually should just be investing. They should just be buying the underlying asset, which is index funds, because they're behind on their retirement, and you need the more volatile but higher reward of index funds to reach a fully funded retirement. As I found from my own whole life insurance policy, it grew nowhere near the illustrative 6% that the life insurance agents showed me at the time. It probably grew more like 2 to 3%. And I've looked into actual policies that many of my coaching clients showed me over time that basically showed the same thing. Most of these policies at the end of the day grow no faster than the rate of inflation. And that's what they're not going to tell you, is that these policies grow really slowly, probably at the rate of inflation. You could be a lot better off buying a bond instead of paying for all the extras, and you don't even know where your premium goes into a life insurance policy. Insurance salespeople are going to really prey on your fears. Oh, what if the world ends? What if there's another depression? All your stocks are going to go away. You need something stable. My friends, that's why when I teach people to save for a retirement in the United States, the first thing I say is you start with a fully funded emergency fund, one that covers enough months of expenses such that it can cover total job loss, like being fired. Another thing is you shouldn't put all of your investments into one risky thing. You hear stories about billionaires like Elon Musk and Mark Zuckerberg who bet everything on one company, but those are the exceptions. Most people who bet everything on one company lose a lot of money. But if you buy an index fund, you're spreading out your risk across hundreds, if not thousands of companies. Just take the entire United States economy, for example. We actually saw an instance where the world almost stopped, didn't it? Back in 2020, that crazy thing called COVID-19. Yeah, the world stopped for a few months. And did the market crash? Yes. But did it completely fall to zero? No. Why? There are humans. Humans still need housing. We still got to eat. And many of us needed health care. Many of us were still online, working on Zoom, using our phones, browsing internet. As long as humans are alive, there's a need for an economy. And within this economy, there are going to be recession-proof companies. And that's why even in a recession, you don't ever see the index, the stock market, fall completely to zero. When an agent uses fear-based language to sell you something, that's a sales tactic, my friends. Somebody who actually cares about you, somebody who actually wants you to win, would not be preying on your fears. They would actually be hyping up your dreams, your values, and seeing things positively instead of painting everything in a negative light. So you know how like earlier in this video, I also said that the vibes of the life insurance industry kind of remind me of an MLM scheme, a multi-level marketing scheme. And that's the sad truth, in that across the insurance industry as well as the financial advisory industry, many of these companies themselves are toxic and predatory even on their own agents. They often recruit agents, young, hungry, recent college grads, or maybe even people who were down on their luck and really needed to make money quick. And because this is a sales-driven environment, yes, you can make money quickly if you close sales. That's how sales work. And the owners of these businesses can, claim that they run 7, 8-figure businesses because they're talking about the top line, the total amount of life insurance policies that they sold. These young agents are lured in with the promise of financial freedom, financial flexibility, do this work from home, remote. Just think about it. You're also being put in touch with somebody who may be very vulnerable and is using victim-based language to sell something that they don't fully understand. They're often selling from a script. And when I ask most of my coaching clients to go back to their insurance agents and ask the hard questions, provide all of the rebuttals that I just taught you in this video, most of their agents either shut up because they don't know how to respond, they get defensive and they double down on something, or they panic and try to ask to control for more of their clients' investments. And those are all red flags. As a financial coach who actually gives a crap and wants you to succeed, my number one rule is that I don't touch people's investments. I actually don't want that responsibility. I want you to be able to own your actions and understand what it is that you're doing so that I'm teaching you to fish, that you know how to do things going forward. That is my pride and joy, is that I'm an educator and a coach who teaches you how to be able to own your financial future, because that's when you are truly free. And as for many of these young agents, look at their backgrounds. Are they trained in economics, finance, accounting? That they work for an investment bank? Yeah, but a lot of people are, Occupy Wall Street, very anti-Wall Street. But you know what? There is something to be said for people who actually took the exams and did the work that happens in real finance. Because many of those people, my classmates and peers who I talk to, recognize that these insurance policies are absolutely crappy products for the vast majority of people that are being sold to. Now, I will end this video and talk about the small population for whom these insurance policies might actually make some sense. There are some people for whom investing and having the discipline to set aside the money to invest is so impossible for you that you need to treat it like a bill. For those people, a life insurance policy might make sense because you get billed once a year, or you break it into 12 monthly payments and you just pay it like a bill, and it forces you to save. That might be appropriate. There's also some people who absolutely cannot be convinced to stomach the volatility and the risk of investing in the stock market. You just really, really cannot stomach that risk. Yeah, a life insurance policy might make sense in that point too, even though I'm still more pro bonds. But you know what, bonds can be hard to understand at first. And then finally, the third population for whom I think these products might make sense is if you are in that very, very ultra high net worth and you worry about estate taxation, then you might actually take some of your money to buy one of these policies to pass more of your estate tax-free to your children. But if you don't fall into any of these three categories, I instead encourage you to take some free classes about investing, whether it is investing in the stock market or investing in real estate. Those two asset classes have been tried and true ways for most people on earth to build wealth. And you don't need to do it through a life insurance sales agent who has less education in finance than you do. Again, this is Sheng from Save My Cents. I'm a nationally recognized expert on saving and investing in your retirement. Thank you so much for watching this video. Don't forget to like it, comment, subscribe, and also check out my caption for more free downloads and resources to help you get on your way to financial wealth.